Thank you very much. Thank you for joining us this morning and not running out for tea too early. So Barton Gold, who are we? What are we doing? Why do we care? And why do we think you should care? In very simple terms, Barton Gold is a pure play gold developer focused purely in South Australia. Very interesting state, very interesting geology, home of BHP's very well-known Olympic Dam, where BHP has consolidated the IOCG belt sort of to the east of the Stuart Highway, which is now Carrapateena, Olympic Dam, and Prominent Hill. We have consolidated all of the historical major exploration and production gold projects in the west side of that basin. So the basin goes from being sort of deep and coppery to shallow and goldy as it heads to the west. So we acquired all of these projects, spent about 3 years doing this between 2017 and 2020. We also acquired the only mill in the region, and the idea was not to restart that project in small-scale operations, but to actually step back, make some pretty significant investments in regional geology, build up a much larger platform, build up a destination of scale or consequence, if you will, and then go back and leverage our stage one or existing mill to start operations, make that transition into operations, re-rate the company, start generating cash flow, and then expand. So it's really for us about a large-scale destination with a much lower risk, lower cost, and much lower dilution pathway. So this is something we've been working on quite a lot. We've just published a study at our Tunkillia project that's recently been upgraded to 1.6 million ounces of gold and 3.1 million ounces of silver. Having done that, we've got the couple steps coming up for us now. One, we are going to be drilling some high-grade silver targets. We've had a really interesting sort of discovery there. We're going to be accelerating mining lease application studies, so predominantly long lead early environmental studies and reserve conversion drilling studies for Tunkillia. And now we're going back and looking back at our stage one area. We're going to upgrade everything that we've got there and look at how we plan to restart operations during 2026. Our capital structure is very simple, very clean. Barton Gold was a brand new company put around these assets. So we have about 219 million shares on issue. We're worth a little over $100 million today. The key thing for us is we have a very, very solid capital structure. So we have a share register where the board and management are the largest shareholders, and we've seen a very strong consolidation of the register by institutional and family office investors around both that alignment of interest, but this very consistent, capital-efficient progress. And one of the great measures of our capital efficiency is that we spend our dollars very well, very efficiently, and we're a very low-cost explorer for what we are yielding, but we also generate capital internally. So we didn't just buy these assets. We're not just investing in growing these assets. We actually sweat these assets. We've generated about $12 million in cash internally over the last few years, essentially co-funding our own activities. So in the last 4 years since we IPO'd, we've done all of these things by raising only $9 million in cash publicly. So it's a very low dilution model, and that's something that we're looking to advance. In terms of our capital structure, our human capital is the most important. We have built a team that collectively in the leadership ranks has got somewhere around 300 years of experience finding, permitting, financing, building, and operating major mining assets in Australia. And that was we have a particularly strong pedigree in gold and in South Australia. Obviously, it's very important to have a strong presence where you are. We're a South Australian-based team, all in Adelaide, full of very passionate South Australians who really want to do something significant for the state. We also have about half of our leadership team coming from the executive ranks of Normandy Mining, which is a name that many of you will remember. Normandy was Australia's largest gold producer and the largest producer in the Southern Hemisphere in the 1990s, until it was acquired by Newmont in 2002. So coming back to the assets, talking about these sort of dual track platforms, what are we looking at? Right up in the northwest of our tenement package, this is where we have our existing Central Gawler mill, the one that we acquired in 2020 and put on hold. And down in the southeast corner there, about 200 kilometers to the southeast, we have our Tunkillia project. So this is where we've just put out our new large-scale study. And the idea was, again, we wanted to start by establishing a destination of consequence, something that would be institutionally valuable. So we focused on that sort of stage 2 expansion area, that Tunkillia project. We've built that up to 1.6 million ounces. We've just put out a study, and that study shows us that this is a very strong cash flowing asset, bulk efficiencies of scale, very, very fast payback, very strong financing profile. So now we go back up to our stage 1 area. We haven't been talking about this a lot for the last few years. We have an existing mill, we have historical existing pits, we have stockpiles, we have tailings, we have a whole bunch of things around there. We also have the existing fully permitted open pit mine at Tarcoola. So what we're going to come back to now there is say, Here's updates on all of the resources and bodies of mineralization that we have. Here's all the Lego pieces we have to play with. And now here are our studies for what it's going to cost to restart our mill, how we want to reconfigure it. Here is how we're going to put it together. Here's our plan, and here's how we're going to start operations during 2026. So the idea is that we have this infrastructure that we can leverage to this very big picture outcome by starting small but cheaply. Instead of going from 0 to 150,000 ounces, we go from 0 to 20 to 40 to 50, and then 150,000 ounces. Stage 1, done well, can be low risk and fund stage 2. And that is how we aspire to keep tomorrow's benefits for today's shareholders. Very much a continuation of our strategy to date. The strategy around scale really comes down to the fact that scale works better than everything, everywhere, all the time. So I'm a big fan of the thesis that if you can mine gold the same way that you mine coal, that is how you should mine gold. And a lot of people think about Australia and Australian gold miners as deep, narrow vein, high-grade underground miners, and that's true. Australia does that very well. However, we like the efficiencies of scale that we can get in open pit operation. We like the defensiveness that we can take in terms of controlling our costs in an inflationary environment. And we profile Capricorn Metals, which is a name that many of you will know, and I hope many of you own. Capricorn is a team that has shown 3 times over the past 20 years that bulk efficient operations really are the pathway to superior profit margins. So we're looking for unit efficiencies, low unit costs, and high unit margins. Capricorn bought their Karlawinda project back in 2015. That was a 650,000 ounce asset when they bought it. They scaled it to 900,000 ounces and 1.1 and 1.3 and 1.5. And then they focused on building it as a scale efficient operation. Today it's a 2.2 million ounce asset, but the resource grade is 0.7 gram per ton. And this is something that people would traditionally say that's very low grade. That may be so. However, today they are one of the lowest cost gold producers in the world, producing 120,000 ounces per annum. And they are right around a $4 billion company. I will take that low grade profile. So this is a project that looked a lot to us like the early data that we saw on Tunkillia. So we acquired Tunkillia just at the beginning of 2020. It was a 550,000 ounce asset. Then we grew it to 900,000 ounces and 1.1 and 1.3 and 1.5 and then 1.6 million ounces. So we've been following pretty much exactly the same growth profile and almost the identical grade profile as well with these guys. And we have now focused on how can we develop this as a bulk efficient operator at scale. What we're looking at when we look at Tunkillia is essentially broad continuous mineralization along the western margin of a very, very large shear zone. The key takeaways here are we have demonstrated the endowment here, the gold endowment, is much, much greater than is historically understood, and we have done that very cheaply. So our average all-in discovery cost per ounce is around 15 Australian dollars. So we're very, very efficient in how we spend our money. We have now tested this very thoroughly as a bulk efficient open pit operating model. Last year in July, we published what we called our initial scoping study. The idea was a preliminary test of scale so that we could solve for CapEx, OpEx, mine design, and then set about optimizing. We've just spent the last 8 months doing a whole bunch of very, very advanced studies to basically do a whole bunch of trade-off analyses, rule options out, bring options in, and significantly optimize this project. And that's given us major savings across both CapEx and energy and brought in a lot of efficiencies. So the results of that are very strong, and it tells us we have a project that will make a lot of money. We are now going to be accelerating some of these long lead, early PFS and mining lease application projects. And we've got a lot of upside potential here. What we're looking at here is just a small section of a very large shear. And we also designed our pits to 3,500 Australian dollar gold. And I'm sure all of us are watching the gold price, but that's a lot less than the current gold price. So there's design growth just in the gold price at current market levels. What does it look like? All right, so we ran our updated scoping study, and basically we were able to lock in a number of major gains. So we grew our resources, we lowered our power costs considerably, we made our process and comminution circuits far more efficient. We were able to save $35 million in capital costs, and of course, record gold prices are sure helping the top line. So the key takeaways are this is a project that will produce somewhere around close to million ounces worth of gold, about 5 million ton per annum processing across 8 years, producing around 120,000 ounces of gold per annum, around 250,000 ounces of silver per annum, and we have an all-in sustaining cost of around $2,200 per ounce. And what that represents is we had a $1,900 AISC in our initial study. We saved about $200 or $300 comparably inside that original pit. We took those savings, we pushed them out into the mine design, we opened the pits up even more. So what we've done is we've taken a little bit more in terms of cost. We've increased our costs by about 20%, but our revenue has gone up by 40%. So it's a very good trade for us. And across the life of the project, we earn about $2,800 per ounce in operating free cash flow, which adds up to about $2.7 billion, 73% IRR, and a less than 1 year payback. And the key things about this project that we really liked from the get-go were that it has a higher grade zone right in the middle. So this is something that really drives the economics here. And we have this starter pit, the sort of first 6 million tons of material that will generate at today's gold price around $800 million in operating free cash in the first year alone. So we can pay back the entire development 2 times over inside the first year. That is why we bought this project, and we're very glad that came true in the analysis. The geometry of the geology is really to account for that. So when you look at this cross-section here, this is right through the middle of the main deposit. This is very broad, bulk-efficient mineralization. It's between 80 to 100 meters wide, so it's a football field long wide. But there's a 300-meter long section right in the middle where we have our starter pit. And this is actually, within this 80 to 100 meters, you have 10 to 30 meters of higher grade mineralization for anywhere from 2 to 10 grams per ton in the block model, and this raises the average grade. The effect of this is while you have a very efficient life of mine operation, when you actually break it down into the pit development stages, we have a stage 1 or a starter pit that in the first 5 million tons of material is not producing 120,000 ounces, it's producing some 180,000 ounces. The first year, the first 13 months produces about $800 million in gross free cash. The first 2 stages, the first 27 months or about just over 2 years, produces about 1.3 billion in gross free cash. So this is a very strong financing profile. And of course, now we'll be looking, hey, where around us can we find more high-grade material to blend into this project and keep creating or prolonging this profile. And this is where we'll quickly look just to the north at Tarcoola. This was the home of high-grade gold in South Australia. So this is where we have our small Perseverance mine there. It's again on a mining lease, fully permitted. What we're more interested in is that southwest corner of our tenements to the west of that mine, which is the historical Tarcoola goldfield. There's about 600 historical high-grade workings here. No one before us had ever gone and put together the story of what's actually driving all of these little gold hits. The mine itself is a small mine. It's not going to be a 1 million ounce mine. It's something that we've put 20,000 ounces in the pit floor, and we think we can grow that a little bit. We don't need this to be big. We just need it to be simple so that we can truck this up to our mill as part of our stage 1 operations. What's interesting is when you look at the wealth that came out of that small hole in the ground, this is only about 60 meters deep. That hole, historical underground mining and contemporary open pit mining, probably produced around 50,000 ounces of gold. So a lot of value very near surface in a very short space, about 450 meters long. When you zoom out and look at the gold field and say what's going on, while we were building Tunkillia, we were building this architectural model for Tarcoola. We published this in November 2011. We drilled it in November 2023. We drilled it in early 2024. And of all of our targets, Tolmer was our favorite target, and we announced a discovery there for gold in August of 2024. Now we went back and we did some geochemical analysis on this to look at how we could use this for modeling and exploration. We did some more drilling, and then we also found a very interesting silver dominant discovery just to the west. So what's happened now with Tolmer is we've ended up having a high-grade gold discovery with higher grade than expected silver in it, and we've had a very, very high-grade silver discovery. So this is what that silver discovery looks like. We have literally 1 line of drill holes across this. So when people ask what it is, it's exciting, and that's all we know for now. We have 7 drill holes, 4 of our intersections rank in sort of the global top 10 tables that get published every week when these things come out. So it looks to be an oxide and transitional sort of body of material at the moment. We are going to be accelerating some drilling to go further west and north and south to try to give this thing 3 dimensions. What's interesting to us is the silver indeed, but does it actually tell us something more about a deeper gold system? We are yet to find out. So for us, it's going to be more of the same, which is doing a lot with a little, being very efficient and creating value. We are going to be moving into long lead commercial programs for Tunkillia. We're going to be accelerating our stage 1 plans and come to you in a couple of months and say, here's how we do stage 1, here's how we do stage 2, here's how they come together, here's our 15-year production pathway, starting at 20 and going up to 150,000 ounces in about 5 years' time, and it's going to cost very little to do. So thank you very much.